Stag Industrial Stock, ticker symbol STAG, another famous monthly dividend paying stock. And I get why. 4.16% dividend yield and 11 years of dividend increases. And the stock itself is performing quite similar to the overall market, in this case the S&P 500. Both are up 11 to 12% year to date. On the 26th of April, Stag Industrial presented quarter results where they beat on FFO and revenue by a small margin, which is pretty nice. But does this all mean that Stag stock is a buy at current prices? My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does Stag Industrial do? Stag Industrial is a real estate investment trust that is involved in the acquisition and operation of both single and multi-tenant properties. Although the majority of the portfolio is single-tenant industrial properties throughout the United States. The vast majority of the company's real estate portfolio is comprised of warehouse and distribution buildings. And if we dive in the most recent earnings report, we see that Stag Industrial reported a net income of $0.28 per share, compared to $0.3 in 2022, so that's a small decrease year over year. FFO was reported at $0.55, which is an increase of 3.8% compared to 2022, so this is looking better already. Another important number, the NOI, was reported at $132.6 million, an increase of 7.8% year over year. Same-store cash NOI was reported at $122.7 million, an increase of 5.9% year over year. Produced cash was reported at $90 million, an increase of 9.3% year over year. And last but not least, occupancy rate was reported at 97.6%, which is a great number in my opinion. I prefer 96% or higher. In here we see again the FFO. It was reported at $0.55, and this is very important. With dividends sitting at $0.36 per quarter, we see that they are easily covered with the FFO numbers, resulting in a payout ratio of 65%, which is below the average for REITs. So this is looking really good. Another really important number to me is the net debt to annualized run rate adjusted EBITDA. Stag is sitting at 5, which is a great number. I prefer 5 to 6.5 here. As I said before, Stag Industrial focuses on the US industrial market, which has a total size of 1 trillion. As of right now, Stag has 0.7% market share, so there's plenty of room to grow the business. The portfolio spans more than 60 markets and the largest market exposure is less than 8% of the total ABR. The portfolio also includes more than 45 industries and the largest tenant is less than 3% of the ABR, so this is looking really well diversified. 51% of the tenants are publicly traded and roughly 32% does 1 to 10 billion in revenue, so we're talking about some big companies here. Amazon is the largest tenant and is sitting at 2.8%, which looks really good. The top 10 makes up for 9.9% of the total ABR, which looks really good to me and well diversified. And now that we know more about the company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analysis every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. Stag Industrial is a 6.47 billion market cap company. And since this is a REIT, I don't want to focus on the PE ratio but use the price to FFO instead. Right now it's sitting at 16, which is a decent number, but in my opinion a bit on the high side. Later in this video I will show you my 3 price targets for Stag Industrial, so make sure to watch until the end, because price to FFO is only telling a small part of the full story here. Revenue is at 671 million, and in this graph we see that revenue went up really nice and steady over a longer period of time. Margins are increasing really good over a longer period of time, but most recently they took a hit, so definitely keep an eye on this number. Analysis expect EPS to decrease quite a bit in 2023, but in 2024 it's expected to see mid-single digit growth. For the revenue, it's expected to see mid-single digit growth in both 2023 and 2024. Return on assets is sitting at 2.8%, which is below my 10% minimum, but for a REIT it's not looking that bad. Return on equity is pretty okay, it's nothing too special to be honest. And the most important number, return on invested capital, is sitting at 2.4%, which is a low number, even for a REIT. It is slightly higher than the 5-year average, which is a good thing. Current ratio is at 1.42, which looks pretty good to me. For this type of company, I prefer a number below 2. Total debt is sitting at 2.49 billion, and I prefer companies that can pay down at least a third of the total debt with the total cash position. Right now, total cash is sitting at 73 million, so they cannot pay down a big chunk of their total debt, which is something that I don't like. However, debt to EBITDA looks good, as I showed earlier in this video, so I'm not worried that much. But it's still very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, do acquisitions and all other things. And in here we see that free cash flow is going up and down quite a bit. This is pretty common for a REIT, so as long as it's going up in the long run, I'm good. And a thing that is also very interesting about this company are the shares outstanding. It's going up in the long run, but REITs issue new shares to raise capital and grow the business. But definitely a number to keep your eye on. Next up are the dividends. Dividend yield is sitting at 4.16%, which is a great number. Annual payout is at $1.47, and keep in mind that Stag is paying a monthly dividend. Payout ratio is at 65%. And again, keep in mind, REITs use FFO to pay out the dividends. The 5-year growth rate is at 0.76%, which is not the highest of course. However, with dividend yield sitting at 4.16%, I think it's all good. They grew the dividends for 11 years in a row, which is also pretty nice. In this graph we see the expected dividend in 2023, 2024 and 2025. Of course, this is an estimation and can be highly impacted by results, but it gives you a rough indication. Analysts think dividends will increase a little bit over the coming years to $1.61 in 2025. Overall, these dividends look pretty good to me, but how about the historical returns? I decided to compare Stag Industrial Stock with the overall market, in this case the S&P 500. Next to that I added First Industrial Realty and East Group Realty. On the 5-year chart we see that Stag Industrial had a 64% return including dividends, versus the S&P 500 sitting at 69% return, so it's pretty similar. Both FR and EGP beat the S&P 500 and Stag. On the 1-year chart it looks pretty different. Stag Industrial returned 11%, while the S&P 500 returned 5%. The other REITs underperformed the S&P 500. On the 6-month chart it's again Stag that is the big winner, with all other stocks returning a lower number here. On the 1-month chart we see that Stag had a flat return, while the S&P 500 is at 3.5%. So bottom line, Stag had the lowest return in this list, but it's not too far from beating the S&P 500. So could this mean that Stag stock is a buy at current numbers? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best deals out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with the revenue growth. For the revenue growth I'm filling in 7%, 9% and 11%, since I think they will increase their revenue at lower numbers versus the historical averages. Next to that, it's also based on the analysis expectations and the current outlook. Profit margin I'm filling in 26, 28 and 30%. For the free cash flow margin I'm filling in 47, 49 and 51. PE ratio isn't the best way to value a REIT, so I just put in 20. For the price to free cash flow I'm putting in 17, 18 and 19. My desired annual return is 15%, since I can get an easy 10% average annual return with owning an ETF. Usually I put in 12.5%, but I want a higher margin of safety with this company since it's a REIT. Right now, Stag Industrial Stock is at $36. I hit analyze and we only see one green number. I'm not focusing on the multiple earnings value, but on the discounted value. We have a low price target of $25. a mid-price target of $32, and we have a high price target of $39. To me, the mid to high price target is the most justified here, indicating it's in the middle of this price target. My final conclusion with this stock is that I really like the business. It's one of the larger REITs in my portfolio, and with reason. It's a great and steady business with big potential in the long run. However, right now it doesn't look massively undervalued because of the increase in stock price lately. For now, I would wait for the stock to come down just a little bit and then buy some more shares, because other than the current valuation, it is a great stock. But remember to always do your own research and never fully trust on what I or other YouTubers say about the stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.